Good afternoon, everyone. Thank you for joining this lunch webinar. Great to see that so many people are interested in this, Belgium at least, very new tax concept, the capital gains tax. Maybe just a few formalities. So we have about 30 slides, about 1 hour that I'm going to entertain you on the Belgian capital gains tax. And then you can ask your questions at the very end. So we have the chat box where you can drop your questions. And then at around 2 o'clock probably, I'll be able to address everything. Hopefully demystify the new concept of the capital gains taxation in Belgium. So I'm going to open the slides, just a second. Then normally this should all be visible. There we go. So maybe a brief introduction on who we are and what we do, because I think about 200 people registered for today's event, and quite a few of them are new clients or prospective clients. So that's always nice to see that there's so many people reading our newsletter and checking what we're doing online. So we're a bit different than the standard tax firms. So our focus is mainly international. We provide both tax and legal advisory services. And we also have an accountancy team that helps with everything related to bookkeeping, accounting, VAT compliance. Our focus is obviously cross-border to make sure that you're not only in order with your Belgian requirements, but also anything to do with your tax compliance abroad. We're currently 11 team members. We have our main office in Antwerp. We have an office in Brussels. And then since last year, we also expanded to the Netherlands with our Dutch colleague Danielle and to the UAE as well. Our focus is on the cross-border employment. So anything to do with payroll advisory, a special expat tax status, your tax planning, your business structuring, both in Belgium and abroad, whether you want to expand abroad or you want to establish yourself in Belgium if you already have a business abroad. Anything to do with your tax filing, so the personal tax filing, mainly, of course, the Belgian one, but if you need assistance in US, UK, France, Germany, Spain, we have our team, we have our network that we can help you with making sure that you're compliant, not just only in Belgium. If you get questions from the tax authorities, unfortunately, nowadays we see more and more questions for information, tax investigations. If you have any problems or issues with the Belgian tax authorities, we're there to assist you. Ideally, trying to solve everything at an administrative level, but when it comes to tax courts, we're also able to assist you in the tax court procedures if needed. And then, of course, international estate planning is also something that we cover. What are we going to discuss today? Obviously, the new capital gains tax, officially in force since 1st of January 2026, but it would not be Belgium if it would not be something, let's say, an asterisk or more exotic in place, because we at the moment do not have an official legal framework yet. So there's been a draft program, a draft law that was issued 17th of December last year. And currently, as it stands, the new capital gains law is not yet officially approved. Notwithstanding the fact that we don't have an official legal framework yet, there is, of course, already a draft legislation in place. And how it stands now will likely not alter too much going forward. So the framework that is currently on the table is likely going to be the framework that will be approved in one of the coming weeks or months. Hopefully, it will all be sorted out in the very nearby future. So what do we look into today? So we'll start with a general overview. What position does the Belgian capital gains tax take within the rest of the investment taxation currently in Belgium? What will be taxed? What is the applicable tax rate? On what will the capital gains tax apply? How is it to be calculated? How is it going to be paid? Is it a deduction at source, or is it something you will have to pay annually through your annual tax return? What happens if you move abroad? what happens if you suddenly arrive in Belgium, the different financial assets, and then the more special cases we will also briefly look into. And then hopefully in about 1 hour from now, we'll close with the Q&A. So this is how it currently stands today. So we have already, let's say, a standard withholding tax on dividends and interest. So if you receive Belgian dividend or interest income, or you receive it from a foreign portfolio, the standard tax rate in Belgium is currently 30%. We have some exceptions. We're not going to go into detail too much on those, but the standard rate is 30%. When it's deducted at source as a withholding tax, which basically means by your Belgian bank or broker, that's usually the final tax, which means that you're not supposed to report anything afterwards anymore in your tax return. You get a full discharge of any tax liability. When it comes to the exemptions, so there is, for interest income, you have an exemption of about €1,000 of annual interest income on your savings account. That's only for Belgian regulated savings accounts. And then there is also the limited exemption of about €833 this year for dividend income. That's per taxpayer per year. So that's something that usually applies already at this moment, 2025 and before. Nothing changes in this regard. Then, of course, the new topic today is the capital gains tax. So they're introducing it 1st of January 2026 with a standard flat rate of 10%. The exemption that applied before in Belgium when you were a prudent investor and were, let's say, putting money in a standard investment, more as a hobby or as what we call it, the good family fodder, when there is actually no speculative or no intent for, let's say, high profit or high loss. And you qualified as a prudent investor before you were never paying any tax on your Belgian capital gains. So that, of course, changes this year. The speculation tax, when in case you were no longer considered a prudent investor, but were considered speculative, in that case, the tax rate before was already 33%. That stays. So nothing changes in that regard. The initial goal was to remove this speculation tax, but because of a political compromise, it's currently still in place. We'll go into detail in that later on, how exactly it will, let's say, work together with the flat capital gains tax. This is something that was already in place, the 33%, and will continue to apply. And then, of course, if you're doing the trading or the investments as a professional activity, that's, of course, something that will be taxed progressively as if it would be business income, salary, or another type of professional earnings plus Social Security. Now, this category is, of course, not relevant for most private investors, but it does exist next to the other capital gains tax rates of 10 and 33%. Let's continue. So the assets that are currently in scope of the Belgian capital gains tax are the shares, bonds, funds, ETFs, money market instruments. So like I said before, the bond funds or mixed funds, derivatives, a bit more specialized. That is obviously not relevant for everyone. And then, of course, also life insurance policies and the Belgian branch 21, branch 23. If you are trading in Forex, the foreign exchange gains is also something in scope of capital gains tax. Physical gold, which I believe is the only, let's say, physical asset that is in scope of the capital gains tax. And of course, crypto. What is excluded? What does not fall under the current CGT tax? The real estate, of course, it is a tax on financial assets. Movable property. So if you buy and sell an artwork, for example, that's not going to be relevant for the capital gains tax. Pension saving funds, anything you do with your employer, the second pillar company pension plans, that's all outside scope, supplementary pensions, so nothing to do. And then, of course, like I said before, if you receive dividends, interest, all of those and other precious metals, apart from gold, they are also exempt from the capital gains tax. Like I said before, you had the approach, if you're a normal manager, a prudent investor, then you were automatically excluded from any capital gains taxation. That now changes, but the distinction with the speculative management obviously remains relevant. And like I said, the 33% speculative tax remains in place. So that's something you certainly have to be aware about. It doesn't disappear. Anything that you had before 1st of January 2026 is normally not considered for calculating your capital gains tax. There's a few exceptions to that. I'll come back to that in a second. So the idea is that since we only introduced the capital gains tax this year, you should take a snapshot of all of your financial assets at the end of 2025. The capital gains tax would otherwise apply retroactively, which is, of course, not the goal of this new taxation. Anything you had before, the value is only relevant on 1st of January 2026. And then, of course, going forward, only the gain that is realized in 2026 or later on, that will be relevant for the calculation of the Belgian capital gains tax. As I said before, there's a 10% flat rate. So you are normally expected to benefit from a 10,000 euro per year tax-free allowance, which basically means anything you generate in terms of capital gains during the year that do not exceed 10,000 euro will not be triggering any capital gains tax. As you can see on the example below, and I just noticed that the title was not, title of each column was not translated to English, but I will explain you what exactly it says. So the first year, 2026, you will benefit from a exemption of 10,000. Let's say this year you don't sell anything, there is no tax exemption to be used, you have not sold anything, no gains for this year. If you don't use the exemption for this year, you will have 1,000 euro carry forward exemption that will be able to be carried forward to next year. So in other words, you don't sell anything this year, you don't generate any capital gains. Next year, your tax-free allowance will be 11,000 euro. And let's say in that example, in 2027, you sell a capital gain, you sell a product and you generate a capital gain of 1,000 euro. Again, from 2027, the year itself, you will also have an additional tax-free allowance of 1,000 euro. Then the generated gain will be offset against the oldest exemption or allowance available. That's why I indicated this in green, because the green one relates to 2026. And like that, it will be carried forward for 5 years. So if you don't sell anything until 2032, you can see it on the line on the slide, there you will be able to benefit from a personal tax allowance of 15,000. How is that relevant? You can see it a bit like a backpack. In each year that you don't generate any capital gains, you will have an additional 1,000 euro allowance, up to a maximum of 15,000. So it's not that after 7 or 8 years, you will have 18 or 19,000. That's not possible. The maximum allowance that can be carried forward is 15,000. Let's say in the example that you have a couple that is married on equal terms. They have a son and they invest in a standard fund that is accruing gains. After 10 years, they decide to sell the fund and the gain realized is 50,000. In that scenario, on the condition that, of course, the parents did not sell anything else for the past 5 years, they are able to benefit from a tax exemption, each of them, of 15,000, which basically means 30,000 for both of them for that given year in which they sell the fund that they invested in for their son. At that point, the difference between the realized gain, 50,000, and the exemption is 20,000. So on that amount, they will pay a 10% capital gains tax. So there you can see that it's not just the 10,000. If you plan it properly, you can, in a situation that you have a partner, for example, you can increase it to a 30,000 euro tax-free allowance. In another example, you have been building an investment portfolio, and on 31st of December, 2025, and like I said before, the snapshot that you had to take of your investment portfolio, the entire value is 50,000. Let's say in 3 years from now, 2028, 2 years, you sell the entire portfolio for 80,000, which basically means a gain of 30,000 because of the fact that you were able to benefit from 10,000 euro personal tax allowance plus the backpack for 2027 and 2028, in total 12,000. Only the difference, again 18,000, is taxable, which will trigger a gain of 18,000, a capital gains tax of 18,000, of 1,800 on a gain of 18,000, so 10% of 18,000. So there, in that context, you benefited from the carry forward of the tax exemption for 2 years, therefore increasing your tax-free allowance to 12,000. Alternatively, and then you could say, okay, you are going to, let's say, change your investment strategy in order to sell certain parts of your portfolio to benefit each year from the 10,000. If you, notwithstanding how the gain was realized, because if the gain, for example, was only realized in the 3rd year in 2028, you can obviously not sell the 1/3 of your portfolio every year. But just let's make it a simple example. Let's say that the gain is realized gradually over the full 3 years. In case that you say, okay, I'm going to sell each year 1/3 of my portfolio, you have a tax-free allowance each year of 10,000. And therefore, if you structure it properly and you generate a capital gain of 10,000 each year, you will not be triggering any capital gains tax in that alternative approach. Just to show that, your investment strategy and the way you buy and sell certain assets will allow you to, at some point, reduce the capital gains tax, or like in this, of course, simplified example, eliminate it completely. The taxable base, so obviously the price that you paid for something or the value that you received. So for example, in the context of a gift or an inheritance, we'll come back to that later on, minus the acquisition value. So that's actually the difference between those two elements is going to be the basis on which you're going to pay your capital gains tax. There are special rules for historical capital gains. I'm gonna come back to that in a second. Any costs that you incur, brokerage fees, exchange fees, the tax, the TOB, the tax on the securities transactions, as I mentioned in the first part of the presentation, all of those expenses cannot be offset against the calculation of your capital gain. So those are not tax deductible, where to some extent they are deductible for dividend and interest tax calculation purposes. They are not deductible for the capital gains taxation. Any losses that you incur, because if investments go well, it's all very nice. It increases in value. You'll pay your capital gains tax. But of course, it can also happen that your investment drops in value. You can only offset your losses against your increases in the same taxable period. So if you, for example, have a loss in 26, have a loss in 27, but you sell only in 2028, the gain realized in 2028, you cannot compensate with losses in previous years. That's what we call historical losses. So there, again, this is something that may impact your investment strategy. For example, we have many US clients. They, for example, take their losses during a certain taxable period. They sell their loss position in order to have their losses recognized and to be able to set them off against their taxable value in the same taxable year. So that may influence, of course, your investment behavior. As I said before, if you have a position that is in a certain year at a loss, it may be interesting to sell it, to create a loss, to offset it against the same, in the same taxable period against value generated. Historical losses, so I gave you the example, if you have losses in 26 or 27, those cannot be carried forward to a following tax year. This is again, let's say, a simplified example. I'm going to have to keep my eye on the time. Okay. If you bought some shares in 2015 for value 100 euro, at the end of 2025, they are worth 120. And if you then sell them this year for 150, obviously, then there is a taxable gain of 30 euro. In the same scenario, if your stock is worth at the end of 2025 only 80 euro, and you sell the shares this year for 90, you will not pay capital gains tax because the purchase price, what you sell them for this year, is higher than their value at the end of 2025. You are not able to offset the capital loss of 10 euro because the losses were not built up after end of 2025, because in this case, it relates to a period before 2026. In the third scenario, if you have stock that is worth 80 euro at the end of 2025, and you sell them in this year for 70, obviously you will have a loss, and that loss can be offset. So then it's not a historical loss, it's a current year's loss. So that's the big difference, and very important going forward. Acquisition value, like I said, you have to look at the situation at end of 2025. In some cases, if you say the acquisition value was higher, I don't know, end of 2024, middle of 2023, the tax authorities give you the flexibility for allowing you for the next 5 years. So for any sales occurring until end of 2030, to take that higher value. So let's say the value was 100 at the end of 2024. The value was only 80 at the end of 2025. In that case, if you have sufficient proof that the value was higher at any point in time before, at any point 5 years preceding the end of 2025, you can effectively show that higher value, but they only allow you to do it until end of 2030. Going forward, after 2030, you'll always have to take the price at the snapshot of end of 2025. Of course, for listed stock, listed securities, that's always much easier to demonstrate, and they're publicly traded. So the closing price of the end of 2025, you can easily look it up online. When it's unlisted, it's of course a bit more exceptional for private investors, but it's possible that if you have several positions in smaller companies that are not listed, then there are certain valuation methods that may be used, not necessarily one. I listed a couple. I'm not going to go into detail too much on that, but you have the possibility to, let's say, choose between different valuation methods to determine your snapshot value at the end of 2025. What happens when you do staggered purchases? So that means that you buy certain securities, certain funds on different moments in time. In my example, 2027, you buy 20 ETFs for 100. You do the same purchase at the end of 2028 for a value of 120, and then you sell 20 for 130 euro in 2029. In that case, they say first in, first out. That's the principle you have to apply. So in that case, there's a difference between first purchase in 2027. That amount is used as a reference to determine your capital gain. Now, of course, again, this is a simplified example. This is, of course, in a situation that you bought the same amount in 2027 and you sold the same amount in 2029 of ETFs. This could become very complicated if you then sell 10, or if you only sell 5, or you sell 35. Then, of course, it's a much more complicated situation to determine your actual taxable gain. There's going to be many special circumstances. What happens, for example, for people that arrive in the country 27, 28, going forward? How do you determine the value? Stock option plans. If you have a stock option plan from your employee, a few of these items will go into detail a bit later on. Shares that are purchased below market value, so at a discount, bonds that are issued below par, life insurance policies, physical gold without purchase evidence. So I think it was end of 2025 that the finance minister announced that for people that would not be able to show when they initially purchased their gold would be taxed on the full value as if the full amount was a capital gain. So a lot of people start selling off their gold at the end of 2025. Now, there have been some clarifications on that, but yeah, a lot of things are, let's say, not that straightforward. And yeah, will trigger questions. Hopefully, we'll get answers to those going forward. But not everything is as obviously as clear cut as the few examples that I gave you before. Now, how the tax will be paid? In principle, if you have investments with a Belgian bank or broker, again, not possible, of course, if you have foreign investments. If you have foreign investments, you're always going to have to declare your capital gains in your annual tax return. If you have investments with a Belgian bank or broker, they will normally apply a withholding tax at source. So as soon as you sell something, they will automatically apply the 10% capital gains tax. So that will obviously not consider your 10,000 euro personal tax-free allowance every year, any losses that you had in the same year, a higher historical value that I explained before, if you take that as a reference point that was relevant somewhere before 31st of December 2025. So all of those, let's say, special items, of course, the bank will not consider. A bit the same now as they apply 30% dividend tax, and you say, I have less than 833 euro dividend income. Yeah, they are not considered either. So you will have to then claim those special deductions, exemptions, losses through your annual tax return. If you say, I'm not going to bother, your withholding tax is final discharge. So any capital gains that's under the opt-in system have been subject to a withholding tax, they are normally not required to be reported anymore in your annual tax return. The situation, how it currently stands, is that Belgian banks are not yet ready to do the withholding at source. So the rule is now until 1st of June 2026 that you will have to report all of those gains that you generate between 1st of January 2026 and 1st of June. Those gains you're going to have to report yourself in next year's tax return. And the opt-in or the withholding tax is not yet in place. Many banks are already communicating now to their clients that they have to decide going forward 1st of June how they will continue, whether to opt out under the current system, no withholding tax applied, or that they will effectively require the bank to deduct the tax at source after June 2026. The difference is, of course, that if you don't do the withholding at source through the Belgian bank, you will normally have to report anything in terms of capital gains in your Belgian tax return, but you're going to lose your anonymity because now withholding at source is completely anonymous. If you're going to put the gain in your tax return, now for a small amount, it should not matter. But if it's significant, yeah, you may trigger questions in regards to the speculation tax of 33%. So I would say, to the extent that it's possible, go for the situation that they apply the tax at source, so you don't have to bother of afterwards reporting it in your tax return anymore. The capital gains tax also applies to legal entities, so not-for-profit organizations and associations. I'm not going to spend any more attention to this, but it doesn't apply to companies because companies are subject to corporate tax. So basically, it's mainly relevant for private individuals. These are the two options that I just explained. So if you have a gain realized of 5,000 euro, the bank withholds the 10% on the gain of 5,000, which basically means 500 euro tax. You're fully discharged. You have no requirement to report the gain afterwards in your tax return anymore. But in that case, you lose the 10,000 euro exemption because it will not be applied at source. You will then have to recover it. But like I said, you're going to lose your anonymity and you could potentially trigger questions in regards to a more speculative investment profile. So if people prefer that, yeah, they better agree not to claim the exemption and just leave all tax deducted at source, as opposed to the scenario that you report everything yourself. So then the bank will not withhold anything. At the end of the year, they send you a statement saying this were your capital gains this year, and that you're going to have to copy paste your tax return, whereby you can then effectively apply for the 10,000 euro exemption. In case that, of course, your gain is only 5,000, yeah, there was no tax due on that, because it obviously is below the taxable threshold. In case of your plans to move abroad, because yeah, we have quite an international clientele, a lot of people come and go. So a lot of people, whether it be conscious departure from Belgium to avoid the capital gains tax, or that it's coincidence that they say, I'm going to leave Belgium, please be aware that there is a trailing period of 24 months. So if you would plan to leave Belgium and you move to another country, depending on what type of tax treaty there is with that country, even if there is one, if you say I'm going to a country that has no tax treaty in place with Belgium, you're going to have to put up a guarantee. And what is the guarantee? The guarantee is the tax due on the value, the capital gain, at the date of departure. So you leave, for example, let's say 11th of April, 2026. At that moment in time, you will have to determine your potential taxable gain. You have to put up a guarantee if you move to a non-EU country or there's no exchange of information with the country where you move to. For example, Switzerland. I was surprised to see that, but Switzerland is an example of a country that has no assistance in recovery. You will have to put up a guarantee. And if you don't sell anything within the next 24 months after you have left Belgium, you will not be required to pay the capital gains tax. Should you at any point before that moment in time decide to sell anything, you're going to have to pay, or at least through the guarantee that you already set up, you're going to have to pay the capital gains tax. Like I said, the relevant date is then not the actual date of selling, it's the actual date that you left Belgium. So that's the 24-month trailing period, which is quite new because before Belgium did not have any form of exit taxation or trailing period. The good thing is that obviously they will only tax you when there is an effective realization. So not like, for example, the Netherlands, and that was going to tax 36%, I believe, on unrealized gains. This is not for unrealized gains. This is for an effectual sale taking place within 24 months after you have left Belgium. And then for the, let's say, the good 20 minutes that we have left, I'm going to look into, let's say, a few more exotic financial assets that could trigger potential questions with people. I've already briefly discussed a few, but I'm going to put a bit more detail on how these different types of financial assets would be treated in practice. So the first one, of course, like I said, your standard listed and unlisted stocks and shares. If you have standard investment funds or ETFs, even the more exotic derivatives, those should normally follow the general rules. So you will benefit from a 10,000 euro personal tax allowance. You should take a snapshot at the end of 2025, unless you have a higher value from the 5 years before that you can demonstrate. And then, like I said, it's either tax deducted at source when you sell something, if you're a Belgian, to a Belgian bank or broker. If you do this through a foreign broker, like I said, always going to have to report your capital gains in your annual tax return. The trailing at the additional exemption of 1,000 euro per year can be increased up to 15,000 if unused. So in any case, I believe that keeping proper documentation of your acquisition value is going to be key to be able to determine your taxable gain. And obviously, going forward in case of a tax audit, that you can always show which reference value was used. The Reinders tax, and I took a picture of the Minister Reinders because a lot of people know the Reinders tax, but not everybody knows Minister Reinders. And just maybe as a, let's say, a joke on the side, Minister Reinders was also the one that was indicted with money laundering at the end of 2025. He was, well, apparently for many years, money laundering through buying lottery tickets. So he sent one of his let's say, employees to buy lottery tickets, and by sort of declaring then the gains in his tax return or on his bank account, he sort of tried to money launder. I would say not the most sophisticated way of money laundering, but that's on the side. He's actually also the one that introduced the renders tax, I believe only 10, 12 years ago. And the renders tax is, like I said, a capital gains tax on funds that consist at least of 10% of bonds, or mainly consist of bonds, or exclusively consist of bonds. So if you're into money market funds, or you're into bond funds, the gain that relates to the bond part, that is subject to the 30% renders tax. Any other part, let's say if it's mixed fund, part is invested in stock, that part, the gain realized there, will only trigger the capital gains tax. So you will never have both together, obviously. One excludes the other, but it is possible that within the same sale, you will trigger both the capital gains tax at 10% and the renders tax at 30%. Just to give you an example, let's say you have a mixed fund, a mixed capitalization fund, or a mixed accumulation fund, which you sell on 1st of January at 150 euro. The TIS value is something specific for the renders tax. It's abbreviation for taxable income per share. That is part of the fund that is consisting of the bonds. In this case, on 1st of January, in my example, 2026, the TIS value is 10 euro. You did a purchase of 150, you sell within 2 years and a half, 30 June 2028, at 250. Obviously, the gain is 100 euro. At that point, for example, the TIS value is 20. How it's then calculated? So you first pay your renders tax on the TIS increase, which is the part that relates to the bonds, which is 30% of 10 euro, 3 euro. And then the part of the gain that does not consist of the TIS value, it's the difference between 250 and 150, namely 100 minus the TIS increase, which is then 90. And that part is then subject to the 10% capital gains tax. So the total tax, 9 plus 3 euro, is going to be the 12 euro that you're going to pay on this type of sale. Just to show that, both exist next to each other, that it's not, there's no double taxation, but in some cases will apply both to the same sale. When it comes to stock options, because investors sometimes invest in regular stock options. Has nothing to do with what your employer can give you in the context of a remuneration package or an incentive. First, when it comes to the employee stock options, we have the law of 1999 in Belgium that taxes stock options grants at moment of grant at a very favorable regime. The capital gains tax initially said would not apply on those stock options, but then afterwards it was adjusted, and they said if you exercise the options, they take the fair market value of the shares, not your strike price, so not the effective price that you can acquire them, but the fair market value at the moment you exercise your options. At that moment, you may trigger a capital gains tax. If you sell them immediately, you're not obviously triggering anything, because if they, in the example that I put there, they allow you to purchase the stock option, they allow you to purchase the share with the option at 20 euro. The market price is 35. At that moment, if you sell them for 35, there's obviously an immediate sale and you will not trigger a capital gains tax. On the other hand, if you say, I'm exercising my stock option and I acquire stock that is worth 35, but you wait 5 years, 3 years, 10 years, doesn't matter, that increase in stock value will be triggering the capital gains tax. Different than for the regular options, there, of course, the exercise price is treated as the acquisition value. Different than for employee stock options where it's not relevant. Again, if you sell them immediately at a higher market price, there is, in that case, may trigger a taxable gain. So that's, I mean, those are more, let's say, complicated, specific investment products. but just wanted to highlight them because people that we see a lot of clients that have stock options granted by their employer. At some point in the future, you may need to consider this relevant for capital gains tax as well. And then for life insurance policies, because that's also something that is quite common in Belgium. Maybe just as a recap, what is a branch 21 product, branch 23 product? The difference is that the branch 21 insurance policy is a guaranteed return. You have a capital guaranteed savings insurance. You put a certain amount in that product, but they always guarantee your initial inlay. Your initial capital will be guaranteed. It's low risk, but consequently, you'll also have a potentially low return. On the other hand, the branch 23 is more market dependent. So you're going to invest in a similar way, but with a difference that there is no capital guarantee. Higher risk, of course, means higher return, but those are the two different types of, there's a few more, there's like branch 26 and things like that, but it's too, let's say, specific to go into detail today. But these are the two, let's say, most common insurance policies. How will it be treated for capital gains tax? The investments that you have in the branch 21, 23, they will not be triggering capital gains tax if you claim the premiums paid into the policy for a tax benefit. And that's what we call the fiscal life insurance policies, or policies that give you a tax benefit under the long-term savings in your personal tax return. That if you have that in place, that will not trigger that will not be liable for capital gains tax. It's only when you are effectively, let's say, not claiming tax benefit, so the non-fiscal life insurance policies, those could potentially trigger the capital gains tax. For example, for a branch 23, it sometimes happens that you switch funds within the contract. Those are tax neutral, so those are not going to trigger any capital gains tax. And then obviously also any investments in the branch 23 that invest in stock and bonds and that generate dividend and interest, those are not going to trigger the capital gains tax either. There is no capital gains tax upon death. So if it's a life insurance policy and the insured passes away, in that case, normally no capital gains tax. Of course, may be relevant for inheritance tax, but normally no capital gains tax. Different than for the branch 21, an early redemption, which normally the maturity period of a branch 21 is 8 years. If you, let's say, cancel the contract, that may trigger a 30% withholding tax. If you let it mature, the branch 21, then upon a future sale, you may trigger the capital gains tax. This is, of course, for the Belgian, let's say, most common life insurance policies. It's going to be tricky to, because I already get a few questions from clients. Oh, I have an investment portfolio or a life insurance policy around it, an insurance wrapper in another country. Yeah, how will that be treated for the Belgian capital gains tax? Yeah, it's going to be an exercise of putting that foreign product or policy under either the branch 21 or branch 23 category, and then hopefully, clarify it to the extent that it could be compared to a Belgian contract, and then may or not trigger or may not trigger the capital gains tax as explained here. Just to give an example, because I can understand that for quite a few people, this could be a bit too abstract. Let's say you have an insurance contract with your insurance company or with your bank for a branch 21. You put 10,000 euro in there in 2020. Then you put on in another premium in 2023 for 5,000 euro. At the end of 2025, again, the snapshot accrued reserves are 18,000. Including, of course, the 3,000 euro return within the insurance wrapper. In that case, of course, we take a picture at end of 2025, which at that point, the 18,000 is the reference value for determining the future capital gains tax. Let's say then in 2026, the capital gains tax is relevant. In 2027, you pay another 5,000 euro premium into the branch 21. And then in 2030, we reach maturity date of the policy. The value is 30,000. Initially, you put 18,000 at snapshot end of 2025, plus 5,000 that you paid in 2027. And that difference, the total 23,000 difference with the contract value is 7,000. So that will trigger a 10% or 700 euro capital gains tax, just to show how this will work for the life insurance policies. The gold bars, that applies to investment gold and some coins. Now it has to do with the gold purity. Yeah, I'm going to spare you the technical details, but any other precious metals like silver, platinum, palladium are all exempt from the capital gains tax. Proof of acquisition value is very important. Remember the example I gave you at the end of 2025 when a lot of people started panicking and selling off their gold by lack of purchase documentation. But this is really important that you improve the initial purchase price or purchase value. Very important to show the difference with the future capital gain. Inheritance. So you may not immediately think about capital gains tax when you receive an inheritance or a gift from a relative or a family member. In principle, of course, the inheritance itself and the gift itself is not a taxable event for capital gains tax. But of course, if you receive a certain security, if it's just cash, of course, it's not relevant. But if you receive an investment portfolio with certain funds in there, and later you're the beneficiary or the heir of whatever assets, financial assets you received, and you sell them, then of course the original acquisition value becomes relevant. It's not necessarily the date on which you became the owner through the gift or through the inheritance, but it's going to be relevant to show, yeah, when the initial security was acquired. So that in that context could become tricky as well. And of course, yeah, it's only the gain built up after you received it that is going to be taxable. But of course, yeah, you're going to have to show a certain value or starting point. Again, the snapshot at the end of 2025 as the earliest reference point. Any higher value before, like I said, can be demonstrated, but only if properly documented. If you cannot show this initial value, that's what you call the step up, then the taxpayer may be liable for full capital gains tax on the sale price. If he's not able to show at a future moment in time, yeah, the initial acquisition value, yeah, then they could say, okay, the full amount of securities that you received will be considered to trigger the taxable capital gain. So again, also in this context, very important to understand proper documentation, proper calculation methods, and obviously, yeah, to keep everything in place to make sure that if a future sale takes place, that you can demonstrate the exact calculation method.
Hey, Gregory,
yes.
that inheritance for the heir, is that, this is Michael, is that assuming the person's a Belgian resident?
Yes, of course. It's Belgian resident as a beneficiary. So
yeah,
if the deceased, if the deceased is abroad, then it could still be relevant. It may not be relevant for inheritance or gift tax, but if you're the beneficiary or you are effectively the heir living in Belgium and you sell something, yeah, then of course all of this is relevant to you.
Right.
I'm gonna address your questions in about 5 minutes. I'm gonna look into the crypto. I may not be relevant for everyone, but I think crypto is a very, let's say, apart from the fact that it's a very interesting topic, it really shows the reasoning of the tax office behind the prudent investor approach and how they usually move to qualifying you as a speculative investor. So the overview you see on the slide, whereby the red cross indicates all of which was relevant before as a prudent investor, usually tax exempt, but not anymore. Yeah, this is true for most investments in general, not necessarily limited to crypto. Now with crypto, it's always a bit more difficult because yeah, the speculative aspect is, let's say, present more easily than with traditional investments, but it really shows the reasoning of the tax office, how they can qualify a prudent investor before tax exempt today, subject to 10% capital gains tax, and how they can put you under the category of the 33% speculative taxation. Now, not necessarily you should worry about declaring a few €1,000 capital gain per year and suddenly being qualified as a speculative investor. I don't think that's going to be relevant. For crypto, it's a bit different because, yeah, crypto has been traditionally an area where transactions happen, let's say, behind the curtain outside the normal banking circuit, and then suddenly show up often multiple of the initial investment. So there, of course, it's an area that triggers the discussion of speculative investments much more easily, but it really shows the nature of how the tax office thinks and how they qualify people as a speculative investor. So usually what was relevant, not spending too much, say, time on this, what was relevant is, of course, at the number of transactions, which counts for crypto, but also for traditional investments, how often you are trading, do you only use your own funds? How much of your own funds do you use? Typically, they say if you put more than 25% of your movable assets in crypto, they qualify you as a speculative investor. Are you focused on long term? Are you often selling, let's say, before the year end, or even sooner than that? Are you using specialized software? So all of those things, yeah, was always a reason for discussion. Now, like I said, the 32% does not disappear, so it's going to stay there. The finance minister, there was about, I think about 4 weeks ago, maybe a bit longer, that was in the finance commission, 100 questions asked about the new capital gains tax to the finance minister. And one of those questions was, yeah, is now the tax office each time going to check whether a person that declares crypto gains, whether he meets the conditions for the speculative investment profile? He said that's not the case, but yeah, there's a difference between practice and what the finance minister says in an initial discussion round. So it's not going to be that easy, I think, going forward. Crypto, of course, is not subject to any withholding tax at source. So if you realize gains, you're always going to be required to report them in your tax return. In combination with the different situations in which you can have a crypto disposal. So it's not only the actual sale of crypto and change into fiat currency. It's also when you switch from one currency to the other, which can trigger a gain. Also, if you pay, if there's a tax audit, the question the tax authorities often ask is, do you have a crypto credit card? If you make payments, the moment you pay with your crypto, yeah, that's the moment that you do a disposal of crypto, and therefore at that moment could potentially generate the capital gain. So that's important. Now, what is true for standard investments, the documentation showing that, yeah, what was the value at the moment of purchase versus the sale, is even more true for crypto, because whereas normal investments are usually in one or two or a few brokerage accounts, yeah, for crypto, it's obviously could be on a cold wallet, a hot wallet, it could be on a platform, could be on a credit card. So there's a lot of things that, a lot of places to look where people can have crypto. If you then do a lot of transactions over a longer period of time, yeah, and then plus the valuation method, because like I said before, for traditional investments, you will have first in, first out. That principle is not automatically applicable to crypto. You can have a last in, first out method. You can have an average cost method. So yeah, there's a lot of methods to evaluate your capital gain calculation. And of course, depending on the method you apply, it can have a significantly different outcome. So therefore, we usually recommend clients that do a lot of trading or buying and selling in crypto to use not only, of course, the platform itself, but on the side as some accounting software, specifically designed to calculate the gains. And there's like Coinly, coin tracking, accounting, coin ledger. So those allow you to effectively manage and calculate your capital gains. So that plus the fact that, yeah, there's going to be an exchange of information with the Belgian tax authorities and in general tax authorities in Europe due to European legislation coming in place as of this year that will be exchanged as of 1st of January 2027, because there was the crypto exchange platforms that need to register now and exchange the information on their clients with the tax authorities. So yeah, I assume we're going to see a lot more clients being questions about their crypto investments. So I think documentation and proper accounting is really key for your crypto investments. Just to finalize, if you want to contact us, I'm gonna go into the questions right away. But of course, if you want to get in touch with us, you have any questions, you can always visit our websites or email me directly. So my email is gg@taxpatria.be.